Understanding your insurance deductibles. Deductible characterized. A deductible is a measure of cash that you, when all is said and done, are liable for paying toward a guaranteed misfortune. At the point when everything goes horribly wrong for your home, or you have a car collision, how much the deductible is deducted, or deducted, from your case installment. Deductibles are the manner by which a gamble is divided among you, the policyholder, and your guarantor. The bigger the deductible, the less you, as a rule, pay in charges for an insurance strategy. A deductible can be either a particular dollar sum or a level of the aggregate sum of insurance on a strategy. The sum is laid out by the particulars of your inclusion, and can be tracked down on the statements page of standard property holders. State insurance guidelines stringently direct how deductibles are integrated into the language of a strategy, and how deductibles are executed, and these regulations can fluctuate from one state to another. How deductibles work. For dollar sum deductibles, a particular sum would fall off the highest point of your case installment. For instance, in the event that your strategy expresses a $500 deductible, and your backup plan has established that you have a safeguarded misfortune worth $10,000, you would get a case's check for $9,500. Rate deductibles by and large just apply to property holder strategies and are determined in view of a level of the home's safeguarded esteem. So in the event that your home is guaranteed for $100,000 and your insurance strategy has a 2% deductible, $2,000 would be deducted from any case installment. In case of the $10,000 insurance misfortune, you would be paid $8,000. In case of a $25,000 misfortune, your case check would be $23,000. Note that with collision protection or a property holder strategy, the deductible applies each time you record a case. The one significant exemption for this is in Florida, where typhoon deductibles explicitly are applied per season as opposed. Deductibles by and large apply to property harm, not to the risk part of mortgage holders or accident coverage approaches. To utilize a mortgage holder strategy model, a deductible would apply to property harmed in a Rebel outside barbecue fire. However, there would be no deductible against the risk part of the strategy, in the event that a consumed visitor made a clinical case or sued. Collecting your deductible can set aside cash. One cash saving tip for a property holders or collision protection strategy is to raise the deductible in this way, in the event that you're looking for insurance. Get some information about the choices for deductibles while contrasting approaches. Expanding the dollar deductible from $200 to $500 on your accident protection can lessen impact. And exhaustive inclusion premium expenses. Going to a $1,000 deductible might save you significantly more. Most property holders and leaseholder safety net providers offer a base $500 or $1,000 deductible. Raising the deductible to more than $1,000 can save money on the expense of the strategy. Obviously, recollect that in case of misfortune you'll be liable for the deductible, so ensure that you're alright with the sum. Property holders debacle deductibles. Wind/hail and storms are covered by standard property holders insurance. Flood and tremor strategies are bought independently by mortgage holders. Be that as it may, every one of these fiascos has their own deductible principles. Assuming you're in a space that is high gamble, for one of these cataclysmic events, comprehend the amount of a deductible you'll have to pay assuming that a disaster strikes. Begin here, really look at your strategies and address your insurance expert to advance precisely the way that your specific deductibles work. Anyways, thank you for watching this video. Don't forget to like and subscribe, and see you on the next video.